Hello, welcome all. So this is Abhilash. So in this session, I'm going to talk on the Unit 3, Corporate Debt Capacity Management and their aspects. Okay, so let's understand what is the meaning of the debt capacity. So what is debt capacity? Debt capacity refers to the total amount of debt a business can incur and repay according to the terms of a debt agreement. Debt capacity refers to the total amount of debt a business can incur and repay according to the terms of a debt agreement. A business takes on debt for several reasons, such as boosting production or marketing, expanding capacity, or acquiring new businesses. However, incurring too much debt or taking on the wrong type can result in damaging consequences. How to lenders make decisions on which businesses to lend their money. So in this session, we will explore the most commonly used financial metrics to evaluate how much leverage a business can handle. At the end of the day, lenders wish to have comfort and confidence in lending their money to businesses that can internally generate enough earnings and cash flow to not only pay the interest but also principal balance. Okay, so So this is the flow of the debt instruments like assessing debt capacity, level of EBITDA, volatility and stability of EBITDA, then balance sheet measures, debt to equity, complications include adjustment to assets, goodwill and cash flow measures, total debt, senior debt, cash flow interest cover, EBITDA. So let me explain all these heads one by one. So assessing debt capacity. The two main measures to assess a company's debt capacity are its balance sheet and cash flow measures. By analyzing key metrics of the balance sheet, cash flow statements, investment bankers determine the amount of sustainable debt a company can handle in M&A transaction. So EBITDA and debt capacity. EBITDA and debt capacity one measures to evaluate debt capacity in EBITDA or earning before interest tax and depreciation and amortizations. To learn more about the EBITDA, so we had a session in the last year about the EBITDA. There you can see the sessions as well. So you have link. The level of EBITDA is important to access the debt capacity as companies with higher level of EBITDA can generate more earnings to repay their debt. Hence, the higher the EBITDA level, the higher the debt capacity. However, although the level of EBITDA is crucial, the stability of company's EBITDA level is also important in assessing its debt capacity. There are a few factors that contribute to a company's EBITDA stability: cycle, cyclicality, technology, and barriers to entry. Cyclical business inherently have less debt capacity than non-cyclical business. For example, mining businesses are cyclical in nature due to their operations, whereas food businesses are much more stable. From a lender's point of view, volatile EBITDA represents volatile retained earnings and ability to repay debt, hence a much higher default risk. Industries with low barriers to entry also have a less debt capacity compared to industries with the high barriers to entry. For example, tech companies that have low barriers to entry can easily be disturbed as competition enters. Even if tech companies are legally protected through patents and copyrights, and competition will eventually enter as the patent term expires or with the newer and the more efficient innovations. On the other hand, industries with high barriers to entry, such as long-term infrastructure projects, are less likely to be disturbed by new entrants and therefore can sustain a more stable EBITDA. Credit metrics. Credit metrics are extremely useful to determine debt capacity as they directly reflect the book values of assets and liabilities and shareholder equity. The most commonly used balance sheet measure is the debt to equity ratio. Other common metrics include debt EBITDA, interest coverage, and fixed charge cover ratio. As you can see in the screenshot, you can see the below screen, right below image, where you can see the numbers, credit metrics, short-term debt, long-term debt. There is total debt with the year-wise numbers. We have a closing price as well. So analysts will look at all these credit metrics in assessing the company's debt capacity. So this is how debt are calculated. Once you added your short-term debt and long-term debt and whatever capital cash you have in your hand, that has been added here. Then interest expenses, the principal of repayment, total debt service 14,000 plus 100 plus 840, that is 15,509, that is the total debt service. Then EBIT earning before interest and tax. Then EBITDA after deducting the earning before interest, tax, depreciation and amortization. So you are getting 30k. Okay, so after adding capex, then fixed changes, that is 16,000. So total debt is 3.3x. How this calculated? It is based on the total numbers. Total numbers. The total debt is divided by the EBITDA. So this is how we calculate total debt divided by EBITDA, 3.3x. Then new debt, uh, net debt to, divided by EBITDA, that is 3.0x. Then EBIT divided by interest 29x. So EBIT is here and the interest rate is here 840. So it is 29x. It is more than 29 times. So this is how this calculated. All formulas are available here. So this is how credit matrix is done. Debt to equity. Debt to equity ratios provide investment bankers with the high level overview of a company's capital structure. However, this ratio can be complicated as there can be discrepancy between the book value and the market value of the equity. Acquisitions, adjustments of assets, goodwill, and impairment are all are influential factors that may create a discrepancy between the book value and the market value of the debt to equity ratio. Cash flow metrics, another set of measure investment bankers use to assess debt capacity in cash flow metrics. These metrics include total debt to EBITDA, which can be broken down further to senior debt to EBITDA, can interest coverage, and EBITDA capital expenditure interest coverage. So here you can see debt service coverage, and the fixed service coverage. EBITDA minus capex minus taxes divided by interest minus interest plus principal. Okay. Total debt divided by EBITDA. The debt to EBITDA measures is the most common cash flow. The debt to EBITDA measures is the most common cash flow metric to evaluate debt capacity. The ratio demonstrates a company's ability to pay off its incurred debt and provides investment bankers with the information on the amount of time required to clear out debt. Ignoring interest rates, taxes, depreciations, and amortizations, total debt to EBITDA can be broken down into the senior. Total debt to EBITDA can be broken down into a senior or a subordinate debt to EBITDA metric, which focuses on debt that a company must repay first in the event of distress. Cash interest coverage. The cash interest coverage measures depicts how many times the cash flow generates the business operation can service the interest expenses on debt. This is the key metric as it's shown on not only the company's ability to pay the interest but also its ability to repay principal. EBITDA capex interest coverage, by taking the EBITDA, deducting capital expenditure, and examining how many times the metric ton can cover the interest expenses. Investment bankers can access a company's debt capacity. The metric is specifically useful for companies with high capital expenditure and including manufacturing and mining firms. Fixed charge coverage ratio. The fixed charge coverage ratio is equal to company's EBITDA capex cash taxes distribution. The ratio is very close to true cash flow measures and thus very relevant of addressing debt capacity. So let's have a look at the debt capacity model. So this is the debt capacity model. You can see the current debt. The principal repayment is the 7%. Current debt is 30,000. Principal repayment of the total debt is the 7%. Interest rate total percent of the debt is the 5% and current cash is the 8,000. Okay, so the total calculation is the 50 per thousand total debt capacity. So how is it is? So the 7% of the principal repayment is the total debt. Okay, so current debt is the 30 and the total debt was the 7 into 30 is 21,000. Okay, so principal repayment is the 21. 21 plus 5%. No, this one interest rate. So 5 3 15. Okay, so 15 plus 21 is around 60 26 36 36 36 around 35 around and 8 then 44. Okay, so current debt is 30,000. Principal repayment, so principal amount which is a to pay, that is the 7%. Okay, so debt was around 54,000. Okay, so current cash is 8,000 in hand. Okay, so after 54,000 the current debt is the 30,000 and after 54 7% debt is 8 to pay, that is means that is around 21 rupees 21,000 and 5% means 9,000 interest rate is 8 to pay. Then revenue is 84,000. Overall the company's revenue for that particular financial year is around 83,700. Gross margin is 49,000. EBITDA earning before interest, tax, depreciation and amortization is 32,500. Depreciation is 20%, tax is stripped, EBIT is 25% and capex is 7,560. Then EBIT will become as a 26,000. Then EBIT capex, EBITDA minus capex is 24 and EBIT minus taxes plus cash taxes is 19,000. So converts the total debt divided by EBITDA. So total debt was 54,000 divided by EBITDA. EBITDA is 32,000. So EBITDA is here. Okay. So EBITDA you can see the 32,000. So it's showing the 3x. Okay. So 3x minimum is 3x. So 32,500 into 3 is equal to 97,500. Okay. So net EBITDA divided by EBITDA 2.66. Then as we have discussed this example in the in last 10 minutes, it's the same. So this is how the EBITDA, then total debt to EBITDA, net debt to EBITDA, then interest rate coverage, then debt service coverage, then fixed charge coverage is calculated basis on these formulas: EBITDA minus capex divided by interest plus principal, and EBITDA minus capex divided by taxes divided by interest plus principal. So minimum 84,000, average is 1,02,085. So this is the result. So so here we are done with the debt capacity, capital expenditure. Thank you. Best wishes.